Welcome back to the Deep Dive. Today, we're doing something a little different. We're not looking at, the latest quarterly numbers or...
Next month's guidance, yeah.
Exactly. Our mission is, well, it's a lot more ambitious. We're applying that multi-decade quality test to Shopify, to SA Shopee.
And asking the big question, is this business fortress, is it actually durable enough to hold forever?
Right. We need to get past all the market noise.
We do. To figure out if this is a truly wonderful company for the long haul, you have to understand its fundamental architecture. And it's this really elegant, mutually reinforcing two-part system.
Okay, let's unpack that.
Yeah.
It's often called the digital razor and blade model, which, that's really the foundation of the whole story, isn't it?
Precisely. We call it the dual engine flywheel. So engine number one, that's the razor, is their subscription solutions.
Okay.
This is the steady, predictable software as a service part, the SaaS component. Merchants pay a monthly fee just to get on the platform.
So it's high margin, stable.
Very stable. It's the financial bedrock, and it just grows reliably year after year.
And then comes the real growth driver, the blades. That's the merchant solutions part.
Correct. And this is huge. It's around 3/4 of their total revenue.
Yeah.
This is the high-octane engine.
How does that work?
Well, it scales directly with the merchant's own success. So as their gross merchandise volume, their GMV goes up.
Shopify's revenue goes up right alongside it.
Exactly. Mostly through Shopify payments.
Yeah.
And then you have other services like Shopify Capital that also feed into that engine.
So, on the surface, their incentives seem perfectly aligned. They only make the big money if their customers are out there selling more stuff. It sounds great, but is it really that simple?
It's powerful. It is powerful because of the huge structural trend it's serving.
Yeah.
Shopify is essentially selling the picks and shovels for the direct-to-consumer gold rush.
The DTC rush, yeah.
And you have to remember, this isn't some zero-sum game against the big marketplaces like Amazon.
That's the parallel economy idea, right? Where marketplaces give you price and convenience.
Exactly. But DTC, which Shopify just makes possible for everyone, that satisfies a totally different but just as strong human desire.
Connection, identity.
Self-expression. People buy their generic stuff on one platform, sure. But they go out and find unique brands to signal who they are. Shopify provides the toolkit for that whole identity economy.
And they abstract away all the complexity.
All of it. The hosting, security, compliance, taxes. It lets a creator just focus on their product.
That structural position seems incredibly durable. But how do they defend it? You mentioned this Lollapalooza effect where their defenses kind of multiply each other. How does that work?
It's not just one moat. It's two distinct forces that work together, and they create this highly fortified position. The first one is high switching costs.
The lock-in.
The lock-in. But critically, it's a functional lock-in, not a contractual one. Think about it. If a merchant is using Shopify for payments, for inventory, for their CRM, it becomes the central nervous system of their entire operation.
So trying to leave isn't just an inconvenience.
It's an existential operational risk. It's a nightmare. They risk total catastrophe just by trying to switch software.
Wow. That is the definition of a sticky customer.
And that sticky customer base is what feeds the second force, the network effects.
Okay.
Shopify has this massive two-sided network. On one side, you have the merchants. On the other, over 20,000 developers and partners.
And those developers are building apps for the platform.
They're building apps that solve every niche problem imaginable. Complex tax stuff, custom shipping labels, you name it. And Shopify doesn't have to spend a dime on that R&D. The community does it for them, which just deepens that functional lock-in for every merchant.
It's brilliant. So the network adds more utility, which makes the switching cost even higher, which reinforces the moat. And we can actually measure the result of this power, can't we?
We can. You just have to look at the attach rate.
What's that?
It's their merchant solutions revenue as a percentage of the total GMV flowing through the platform. And that rate has been climbing steadily.
So that's the proof.
That is the definitive quantitative proof of their pricing power. They are monetizing their own captive base more and more deeply over time without just jacking up the subscription price.
Okay, so that attach rate proves the power.
Yeah.
But let's pivot, because this is where it gets complicated, the scuttlebutt. What happens when a company has that kind of pricing power, but maybe not perfect service?
This is the golden cage thesis.
Exactly. I'm seeing just widespread complaints Merchants do not seem to universally love Shopify.
And this is the paradox you have to get your head around as an investor. The complaints are, well, they're vociferous. High fees are number one. And number two is customer support being, and I'm quoting here, the worst it's ever been.
It's just a frustrating AI loop, right? You can't reach a human.
Yep.
Logically, that just sounds like a huge weakness. I mean, if your customers are that unhappy about price and service, they should be leaving for a competitor. Big commerce, WooCommerce, whatever. But they're not. Why?
And they don't leave. And that, paradoxically, is probably the strongest possible evidence of their world-class platform monopoly.
Because if they complain but stay.
When a captive customer base complains endlessly about price and service but endures it year after year, it just confirms how high those switching costs really are. They are, for all practical purposes, trapped in that golden cage.
So the total cost of ownership is just lower, even with the high fees.
It's lower and, more importantly, less risky than trying to transplant their entire operational nervous system.
Okay, let's talk about the keeper of this cage then. The CEO, Tobias Lütke. I mean, his philosophy of building a 100-year company sounds amazing for long-term investors.
It does.
And his pay structure, all long-term equity, 0 short-term bonuses, it suggests perfect alignment.
The alignment is excellent, but we can't just gloss over the giant governance paradox you have to swallow here.
A founder share.
The founder share. This is what gives governance experts, nightmares.
It should.
Back in 2022, Lütke secured 40% of the voting rights, indefinitely, even if his actual economic stake drops to, 2%.
And this was passed against the will of the majority of economic shareholders.
That's right. So from a traditional governance perspective, it's a disaster, a catastrophic centralization of power.
So any investment in Shopify from that day forward became an explicit bet on Toby Lütke as a benevolent dictator. You're not just betting on the business model, you're betting on his rationality for the next, 20 years?
You are, 100%. But here's the counter-argument, and it's a strong one. That absolute control is what allowed him to face the single most important test of his entire leadership.
The rationality test.
The rationality test of 2023. The logistics divestiture.
Yeah, from the outside, that whole thing looked like a total panic move.
I think it was an act of profound intellectual honesty. Remember, after the pandemic boom, Shopify went all in on building a fulfillment network. They bought companies like Deliverr.
A huge capital outlay.
Huge, and they realized pretty quickly it was a low-margin, capital-intensive cash flow trap. It was actively dragging down the beautiful asset-light software business at the core.
And he had the courage to admit that. A multi-billion-dollar M&A mistake. And then to just cut it, sell the whole thing to Flexport, lay off 20% of the company. It's just stunning.
He killed his own favorite project to save the business. That is passing the rationality test with flying colors. It shows he values the long-term health of the company more than his own ego.
And the founder share is what allowed him to do it without an activist breathing down his neck.
He used his immunity to make the right, ruthless, long-term decision. And that decision, that admission of error, created a structural change in the whole company.
Let's focus on that financial pivot, because you're right. The 2023 move created a structural and I think permanent change. This is not the growth at all costs story stock anymore.
Not at all. That company is gone. The key metric you have to watch now is free cash flow.
And just for anyone who's not familiar, what exactly is free cash flow?
It's pretty simple. It's the cash the business generates after you pay for all your operating expenses and any capital spending needed to maintain or grow the business. It's the cash that's truly free for management to use.
For buybacks, dividends, whatever.
Exactly. And Shopify has now delivered 9 straight quarters of double-digit FCF margins. And it's accelerating, moving toward the high teens, low 20s.
And that's durable because the capital-heavy logistics business is gone for good.
It's gone. Add to that a pristine balance sheet, almost $6 billion in net cash, and you're seeing the return on invested capital, the ROIC, which used to be negative.
During the logistics push.
Right. Now it's inflecting sharply into strong double digits. The asset-light software model is back in control.
So that structural change is the whole bull case financially.
It's the core of it. Going forward, growth isn't just about adding more merchants. It's about deeper monetization, pushing that attach rate even higher, expanding payments and capital, and, crucially, moving upmarket into the enterprise space.
Which brings us to the next growth engine, commerce components. How does that change the game for them?
It's so smart. It lets massive companies think, Mattel? global apparel brands, use only the specific parts of the Shopify stack that they want.
So they don't have to rip and replace their whole system.
Exactly. A company might have a super complex backend they've used for 20 years, but they want Shopify's world-class checkout. They can just pull that one component into their system. It lets Shopify monetize companies that are 10 times larger than their usual customer.
That massively reduces the friction for adoption.
Yeah.
Okay, but we have to talk about the risks. The permanent impairment risks.
Absolutely. The first one is non-negotiable, key man risk. Like we said, the whole thing rests on Lütke's continued rationality because of that founder share.
Then you've got disintermediation, the big fear that a TikTok or an Instagram finally builds a truly seamless native checkout experience.
And that would relegate Shopify to being just a dumb pipe in the background. It's a real threat.
And the last one.
The long-term risk of that golden cage resentment. If that deep merchant frustration over fees and support just festers forever and is never really addressed,
It leaves an opening.
it leaves a huge opening for a truly disruptive competitor to finally come in and offer a way out. Resentment is competitive fuel.
So, with all that,
Yeah.
what does it mean for the price? We have a wonderful business, proven stewardship, gushing free cash flow, but the valuation is, it's clearly high. PE ratio is well over 150.
Of course. The market is pricing in decades of compounding growth, a wide moat, and tons of optionality. For you, the investor, the margin of safety here is not statistical. You're not going to find it in a low PE ratio.
It's qualitative.
It is entirely qualitative. It's a bet on the durability of that golden cage and the proven intellectual honesty of the founder.
This really requires second-level thinking. The first-level take is easy. The stock's too expensive, that PE is insane.
But the contrarian second-level view is that the market is still sort of anchored to that old narrative, the pre-2023 cash-burning growth story. They see the high PE and anchor it to old depressed earnings.
What are they missing?
They're missing that the 2023 FCF inflection was a permanent structural shift to an asset-light, cash-gushing compounder. You're paying a premium for that guaranteed quality.
Which leads us to the final provocative thought for you to take away. Is that current premium just the price you have to pay for an exceptional, proven, high-quality business? Or is the entire investment thesis really just a non-diversifiable speculation on a benevolent dictator whose rationality, while recently proven, also led him to make a multi-billion-dollar mistake in the first place? Something to chew on as you assess the endurance of this golden fortress.